So Uganda is in the middle of a massive tax shakeup, one of the biggest in years, and it's all set to go live for the 2026-2027 financial year. Now, this isn't just some boring government paperwork. These changes are going to reach into every corner of the economy. We're talking about everything from your monthly paycheck and what you pay for fuel, to how local shops and even huge international companies do business. So let's break down what this big tax shakeup really means for your wallet.
Here's how we're going to tackle this. First, we'll look at the government's absolutely massive trillion-shilling goal. Then we'll zoom right in on how this hits your personal finances and affects local businesses. After that, we'll pull back to see how Uganda is positioning itself on the world stage before we get to the real bottom line: who actually wins and who foots the bill.
So let's kick things off with the big one. Why is the government even doing all this? Well, it all boils down to a single, incredibly ambitious revenue target.
1.741 trillion Ugandan shillings. Yep, you heard that right. That's the mind-boggling amount the government is planning to raise just from these new tax policies. A number like that tells you this isn't just a minor tweak, it's a whole new strategy.
And, this isn't just about plugging some short-term hole in the budget. It's a long-term play. See, Uganda's tax-to-GDP ratio, basically how much tax it collects compared to the size of its economy, has been stuck around 13%. That's quite a bit lower than the average for sub-Saharan Africa. The plan here is to close that gap, rely less on foreign loans, and basically fund the country's growth from the inside out.
So where is all this money going to come from? Well, a huge chunk is from higher taxes on things we all use pretty much every day. We're talking more on fuel for your car or boda, a lot more on sugar and cooking oil, and even a big jump in the cost of cement if you're building. Every single one of these increases is designed to send ripples through the whole economy.
Okay, so that's the big picture. Now let's bring this right down to your wallet. Because beyond the price of goods going up, there's a major change coming directly to your payslip.
All right, this is probably the single biggest piece of news for anyone with a paycheck. The tax-free threshold for pay-as-you-earn, or PAE, is going up. It used to be that if you earned more than 235,000 shillings a month, you started paying income tax. Now, that number is jumping to 335,000. This is real, direct relief for lower-income earners, letting them keep more of their hard-earned money.
So here's what the new brackets actually look like. The big win, of course, is that much wider zero tax band right at the bottom. That's fantastic. But as you move up the income ladder, you can see the bands have been reshuffled, and there's even a new 25% rate squeezed in there. It's a classic give and take. Some genuine relief at the bottom, but a new tax structure for everybody else.
Okay, so that's the story for individuals. But what about businesses? Well, for companies, especially the smaller ones, these reforms are a real mixed bag. There's some genuinely good news, but also some serious new hurdles to jump over.
Let's start with the good news, and this is a big one for small businesses. The annual turnover you need before you have to register for VAT is jumping from 150 million shillings all the way up to 250 million. That's a 67% increase. This is huge. It means thousands of smaller businesses are now off the hook from the headache of collecting and filing VAT, letting them focus on what they do best: growing.
And it's not just us saying it's a smart move. Experts are really backing this one up. As this legal take puts it, it's about restoring equity. It's a recognition that the cost of all that paperwork was hitting the smallest businesses the hardest. Plus, it lets the Uganda Revenue Authority, the URA, focus its energy on the bigger taxpayers.
But of course, with good news often comes a new challenge, and that challenge has a name: e-FARS. For any business that is still big enough to be registered for VAT, this electronic invoicing system is now a must. It's designed to give the URA a real-time look at transactions, to cut down on tax evasion. The catch? If you fail to use it, you're looking at some heavy penalties. It adds a whole new layer of tech you have to get right.
Now, I want to clear something up because this next point was a really hot topic. You might have heard talk about a new minimum tax for businesses that kept reporting losses year after year. Well, after a ton of debate, Parliament actually rejected that idea. So to be crystal clear, that plan was scrapped. It's a major win for businesses who argued it would have been an unfair penalty on companies that were genuinely struggling.
All right, let's pull the lens back a bit. Because these changes aren't just happening in a vacuum inside Uganda. They fundamentally change how the country plugs into the global economy, especially when it comes to money earned outside its borders. This is a straight-up game changer. Uganda has joined a global agreement to automatically share financial information between countries. What does that mean? Well, the days of having money tucked away in a foreign bank account that the URA doesn't know about? Yeah, those days are pretty much over.
The tax authority now has a window into assets and income held by Ugandan residents all over the world.
So, who needs to be paying attention here? Well, the net is cast pretty wide. We're talking about Ugandan citizens working abroad, expats living and working in Uganda, any resident who has a foreign bank account, and of course, Ugandan companies with operations overseas. The message is simple. If you're a tax resident of Uganda, your worldwide income is now on the URA's radar.
Now, for foreign companies, there's a new two-letter acronym they absolutely need to know. PE, or Permanent Establishment. Simply put, it means if a foreign company creates enough of a taxable presence in Uganda, it can be treated as a local company for tax purposes. It's a massive risk. Imagine hiring a consultant who can sign deals on your behalf. You might have just accidentally created a PE and opened yourself up to a whole world of local tax obligations you didn't see coming.
So how can foreign firms avoid this trap? It's all about being incredibly careful and deliberate. First, you have to clearly define the relationship as an independent contractor, not an employee. Second, lock it all down in a rock-solid written contract. And third, you have to get the taxes right from day one. One slip up here could lead to a massive, unexpected tax bill down the line.
All right, we have covered a ton of ground here, from your personal paycheck to global tax law. So let's boil it all down to the bottom line.
So when all the dust settles, a pretty clear picture emerges. Low-income earners are the definite winners here, getting more take-home pay. Small businesses get a huge break from VAT, but have to deal with the new e-invoicing system. Consumers? Well, they're going to feel the pinch with higher prices on fuel, food, and building supplies. And foreign companies? They're facing a much tougher, more complex tax environment.
And really, it all comes down to this one core challenge, this tightrope walk. The government desperately needs to raise more money to fund its plans and be more self-sufficient. But the way it's choosing to do it, by taxing everyday items and tightening rules for business, comes with a very real risk of slowing down the economy and making life more expensive for everyone. And that leaves us with the million-dollar, or maybe the trillion-shilling question. Is this whole new tax strategy a necessary step for Uganda's growth, or is it a burden that might just end up slowing things down? How that balance plays out will really define the country's economy for years to come. Thanks for joining us.